James is a new CFA charter holder. He passed and he became a charter holder within the last few months. Isn't that right, James?
That's right. Got it probably a couple weeks ago, actually.
So if you wanted to say anything about the process, I'm sure the students would enjoy hearing you about that as well. I think it's a great discussion point and something that's really valuable for all students to consider.
Yeah.
With that, let me go ahead and let you take it away. You have a list of questions, James and Mary Catherine. So you'll be going through those topically as you've decided already in advance. We will not take any questions from the students at this time, but after James and Mary Catherine and anybody else who joins is done with answering the pre-written questions, then we'll open it up. I do have a couple of extra bonus questions to ask at the end as well, or I shouldn't say bonus, but late questions that I will ask James. And I'll probably email those over to you in just a little bit as well, so you can see that. Finally, the students will be able to ask questions. Professionals, professors, and so forth, we will not ask any questions. So it will be all on Ibotta and on the students. Thank you, James and Mary Catherine. All yours.
Yep, absolutely. Well, yeah, I'm James. As Peter mentioned, I'm a senior associate on our corporate finance team here at Ibotta. I've been with the company for about 3 years and recent CFA chart holder. I guess just a quick note on the CFA program. Definitely would highly recommend it, as Peter suggested. It's a fantastic program. Definitely found it very intellectually stimulating. The subject matter, really covers a wide range of topics, and I've really found that it's expanded my knowledge base across several domains. So I'd highly recommend it. And then joining me today is my manager, Mary Catherine.
Yeah, my name is Mary Catherine. Mary Catherine Broderick. I've been here at Ibotta almost 5 years. So I've been able to experience a lot of different changes at the company. And was definitely excited to work with James and others here on our recent IPO. Prior to joining Ibotta, I spent time in investment banking and venture capital. So it's been fun this is my first time really working for a company, and it's been fun to be able to be part of such a transformative year for us. Peter, I think you mentioned, us just starting to kind of go through each of these. So we figured we'd kind of popcorn back and forth. We can read out each question as we go, and then kind of provide the answer as we see fit. And then just let us know if you want us to stop at any point, or if there are any kind of like follow-ups or places that you feel like we might need to pull the thread a bit more.
That's great. And if you just see something that you want to just quickly summarize as far as the question goes, you don't have to read every word if you don't want to. It can be totally up to you.
All right, sounds great. I'm going to start with first.
Sure. So the first question is about adapting to change. And the question is, do you think that stores adding dynamic pricing will potentially impact Ibotta? We absolutely believe that this could be a tailwind for us in the future. I assume by dynamic pricing, you're probably referencing electronic shelf tags. We envision a world where there are electronic shelf tags in aisle, and on those electronic shelf tags, you can place an offer, or there will be a flashing light to indicate an offer. And from our perspective, we really think that this removes a lot of the friction that currently exists with in-store shopping and promotions. Oftentimes you have to, in the case of Ibotta, plug in your loyalty number, redeem a receipt. It's kind of hard to search for the product. And so we just think that will reduce a lot of that friction and lead to higher redemption rates across our network.
So there are two questions here specifically on capital. The first being, as it relates to insider activity and strategy alignment. The question was, it seems that some of our initial investors are using our publicly traded status to realize gains, while others are increasing their stake. And I guess the crux of the question is, what is driving this, and do we expect them to stay invested for the long term? And so you're definitely correct. There are initial investors that invested looking for liquidity. I would say at the IPO, you see a lot of immediate churn. However, there are also investors that are long-term and will be around Ibotta for 10 plus years. And that's just part of their broad investment thesis. I think what you see more recently with some shareholders increasing their stake can oftentimes be, when we IPO'd, the price was 88 a share, and you've seen declines since then. So you'll have stakeholders who are going to start buying up because they do believe in the long-term growth of the business, and they know that the stock is undervalued, or believe that the stock is undervalued today. So that's why you're going to see them increasing their stake, just because of that thesis, but the long-term perspective on the overall stock. And so then I'm just going to go ahead and knock out the other capital question as well. How are you going to finance in the future, and are you going to take on debt or issue more stock? So I think both are always a possibility. However, in the IPO, we raised a very large amount of cash. And I think the other thing to note is, if you look at our financial statements, you'll know that we are cash flow positive, free cash flow of over 100 million at this point. And so there's really no need to take on any additional debt or equity today.
Yeah, the next topic, we've got one on the competitive landscape, asking about our competitors, both public and private. We have a handful of what I would consider to be pure play direct competitors. Those companies are private, and they include Inmar, Neptune Retail Solutions, and to a lesser extent, Fetch Rewards would be another good example. Inmar and Neptune both really don't have a direct consumer presence like Ibotta has. They're more focused on the B2B white label solutions that we also provide. Fetch is more of a direct consumer competitor to a certain degree. They source budgets from the same CPG companies that we do, and distribute those across their D2C platform. The business model is a little bit different. You're simply uploading a receipt, and you get a certain number of points that you can then convert into cash, whereas Ibotta, you are redeeming specific offers. So just a slight nuance there. But over time, we really see our competitors becoming the larger companies that you all know in the ad tech space, that include Google, Pinterest, Snapchat. We really believe, as we demonstrate the efficiency of Ibotta's product, really over the next couple of years, that we will be competing with these companies for budget allocations from CPG brands. And I'm sure we'll get into that in more detail in some of the later questions.
Regarding diversification, there was a question around Ibotta's revenue streams from partnerships with other major retailers, and if there are any current plans to diversify to non-retail sectors like healthcare, wellness, travel, finance, etc. So I would say our current diversification initiatives are really around our content. So primarily, you can redeem CPG products on Ibotta's platforms or other publishers. But then you can also, we're expanding into general merchandise. So you can, there's, pet, electronics, health and beauty, etc. But that's really in terms of like the content that we are providing on our different platforms. We do have initiatives around publisher diversification as well. So today, those are largely, CPG retailers, grocers, etc. But there are initiatives in place for us to go get more, again, in the pet space, electronics, etc. I would say those kind of go hand in hand. And that's really where you'll see diversification in the near term for the company.
Yeah, the next topic is ESG. So there was a question on Ibotta's ESG policies, whether or not we see ourselves as leading or lagging compared to other companies, excuse me. I can't speak too specifically to this one. I think it would probably be more of a question for someone on our people team. However, being in a lot of conversations with our executive team and others throughout the company, I do definitely believe that we are forward thinking in this area and highly conscious of potential ESG implications, and we're constantly actively benchmarking ourselves against the industry and best practices.
Especially given the underlying premise of the company is that you don't have paper coupons anymore, which creates a lot of waste.
Right.
Brian, our CEO, speaks about that pretty consistently. Okay, so into the financial section, moving past ESG, there was a question, just looking at the finances from Q3 2023 to Q3 24 on our G&A expense and noting the 40% year-over-year increase. So that is primarily stock comp related to going public. Obviously, there was stock comp before, but that changes materially as a public company. So if you were to strip out the stock comp and look at it from a non-GAAP perspective, as a percent of revenue, our G&A would remain relatively flat year over year. The next question, or you can do the next question.
Yeah, so the next question is about projecting revenues and how we think about factors like inflation. There are a lot of different complex dynamics that we consider to model the business, especially revenue internally. But from a Wall Street perspective, we've really communicated our business in terms of a pretty standard P times Q model. So you can think about that as a number of redeemers multiplied by a number of redemptions per redeemer to get to a number of offers redeemed. And then we earn a fee on each redemption that occurs. You multiply those two together to get revenue. In terms of considering inflation specifically, I can't speak too specifically to kind of our expectations internally, but generally speaking, we model approximately 2 to 3% for inflation and then consider other factors.
There was a question on our cap software expense and what internal decision-making Ibotta uses to determine whether or not to capitalize or expense software development costs. And so there is a lot of rigor around this internally, as I think probably there is at every company. And we use certain softwares to track time of our engineering team and how they're building and how they're allocating their time. But capitalized labor is, I would say, generally speaking, associated with the construction of new assets for the company. So for us, for Ibotta, that would look like if we are developing new parts of the platform for a new publisher integration, whether that be, we've recently announced our partnership with Instacart, and if there are new parts of the platform that have to be developed for Instacart specifically, whether that be dashboards or what have you, that would be capitalized expense. And then other app development. So like if you're looking at our D2C, if there's anything that has to do with our app or our web browser extension, those would be the type work to develop new aspects of the platform that would be capitalized expense.
The next question is regarding some commentary that we made on our third quarter earnings call. We mentioned that we typically see seasonality in the back half of the year, particularly around Thanksgiving. Just to quickly touch on that, obviously it's a high point for retail and grocery shopping around the holidays. And then since 2020, we've run our Thanksgiving marketing campaign for our direct-to-consumer platform that typically brings a meaningful number of new users into our platform, which also helps, at least in period, our revenue, but also increases our expenses a little bit. In terms of kind of the growth and margins that we expect this fourth quarter, I would point you all to the guidance that we gave during our third quarter call, which was $100 million to $106 million in revenue and $30 to $34 million in adjusted EBITDA. If you kind of look at our financials, you might note that there's not much of a pickup from the third quarter this year. It's turned off. The third quarter this year to the fourth quarter. And this can be attributed to the fact that we really had such strong performance year to date. And so we actually exhausted many of the CPG budgets that we secured at the beginning of the year, leaving less of those budgets to then be deployed in the fourth quarter. Brian, our CEO, provided some commentary around this on our third quarter call, so I would definitely encourage you to go take a look at his remarks. But we expect this kind of short-term supply constraint to be alleviated in coming quarters as we re-up those CPG budgets to match the increased redeemer count that we've seen and the increased demand from those redeemers.
Okay, the next question here is with regard to the CFA kickoff presentation. So it says, Ibotta cited 3 areas of durable growth, which were identified as growth in redeemers, advertising, and enhancing the IPN. Specifically, the question is, what are the estimated annual growth rates for each of these and over what period of time? I think the best way to think about this would really be to look at some of the consensus estimates for total growth. I think it's correct. We do generally expect these buckets to grow. Redemptions per redeemer is really a huge driver of our business, right? And that grows as our offer quantity and quality increases. As James mentioned, we did run into what I would call some supply constraints this year and just here at the end of the year. But as those budgets get refreshed in the beginning of the year, you're going to see, or you would imagine that will allow for increases with those increased budgets. I think growth in redeemers, this is something that you'll continue to see as we add new publishers, and fee, fluctuates seasonally, depending on the offer mix available on the platform. Let's see, I'll just knock out this next one really quick. So what does Ibotta estimate for its CapEx in 2025 and beyond? And what are these expenditures for? In a lot of ways, this is a great question. We are not a capital intensive business. And so I would say that's not something that we would really expect to change. What you look at in our historical figures in terms of CapEx as a % of revenue, I think that's a fair assumption for what you would expect going forward. We do have a few initiatives like we're moving into a new office building next year. So we might see some CapEx associated with that as we build out some new areas of the office, or we'll have to invest in, desks or computers, et cetera. But generally that's not something that we would really see changing. And I wouldn't, extrapolate much from that. It's not going to be that capital intensive either.
Yeah, I'll knock out the next two. So the next question is asking if there are any assumptions that we think analysts have misinterpreted in the past when modeling Ibotta. The question specifically asks about assumptions and growth rates. I don't think necessarily any assumptions or growth rates have been misrepresented per se. I think one potential point of misunderstanding in the past has been really just how our offers are distributed across our network. So we source what are called national budgets and national offers from CPG companies. National meaning we primarily source, I should say national offers, but meaning that they can be distributed across our entire network to any retailer, which means that if, you know, our Walmart business is doing really strong, there may be less rewards available to be consumed on the direct-to-consumer platform. So we've seen our direct-to-consumer business actually decline year over year in 2024. And I think, you know, if you just look at the face of our financials and the corresponding supplemental detail, you might think of this as concerning. But really, when you understand that we are truly agnostic to where an offer gets redeemed and that we get paid the same fee regardless, I think that illustrates that, you know, our overall business is really thriving, especially on the redemption revenue side, as is evidenced in the growth rates that I'm sure you all have taken a look at. And then the next question is about, are we prioritizing growth or profitability? I would just comment that we have a very high degree of operating leverage, meaning we have a largely controllable and fixed cost base. So that means really as you grow your revenue, your profitability also improves. So we're focused on both growth and profitability, and thankfully our business model supports us trying to achieve those objectives.
The next question here is on the economics behind our two sources of revenue. So as you all know, our primary sources of revenue are redemption revenue and then ad and other, as was broken out on our financial statements. So the question is, you know, what are the margins in each and where do you see more favorable growth between these two sources? So our redemption revenue, the way to think about that, and this is illustrated in our S1, is it's the MSRP of a product, which typically CPG products have low MSRP. So let's just say $5 MSRP. If we have a promotion against that product, we will invoice that CPG brand $2 for a $5 product. And of that $2, $1.20, this is just illustrative, $1.20 would go to the user as a user award. And then Ibotta would keep 80 cents as our redemption fee. And so that is ultimately, it's all of those redemptions and each of their fees combined that create our redemption revenue. So the margin on the revenue side, and it's also our higher growth segment, because that is our redemption revenue is what we recognize not only on the D2C platform, but also across all of our third-party publishers. Our ad product business is also high margin. However, this is today only something that we can serve ads to our direct-to-consumer app users or on our website. And so we don't serve ads on any of our third-party publisher platforms because those are all white label. So it's definitely not as high growth as our D2C platform, our redemption revenue area of the business. And I'd say it's also just very dependent on the number of eyeballs on our D2C platform. So as you know, there are more and more eyeballs and redemptions happening on D2C, you'll still see ad products grow. But to the extent that's moving to 3PP, and you're seeing more growth there, we're not going to be serving ads on our third-party publishers, so you're not going to see the same amount of growth. Talking about growth, the next section of questions is on growth, and the question as to whether or not we would expand to working overseas, or expand overseas and working with grocers there. And I would just say at this point in time, that's not something that we've really talked about publicly. So kind of full stop on that.
The next growth question is about emerging markets and deploying capital globally, so international expansion. Assuming by emerging markets, you mean emerging economies. I would just reiterate MC's previous answer. But in terms of emerging markets within CPG brands, there is an opportunity to expand our relationships with long tail CPG clients that are smaller and typically, would spend below 100 or $50,000 with us per year. In the past, we haven't really worked as much with these clients just because there's a certain amount of administrative overhead that is associated with setting up an offer, getting it live, and then ongoing campaign management. And so it just hasn't made sense from a revenue to cost ratio. But this is something that we're working on changing actively as we speak, just to make our offer setup process more automated. So I believe on our third quarter earnings call, Brian talked about making our offers easier to use for these brands. And how we'll do that is by creating a campaign manager that's automated where they can go into the Ibotta system, set up offers themselves, manage those offers, track the performance. So that way they never really have to interact with anyone on the Ibotta side. Certainly they can, but it will really help reduce some of that administrative burden. And so we think that's actually a pretty large untapped market. While they may be spending on an individual client basis a lower dollar amount, when you add all those small CPG brands up, it can make a meaningful impact in terms of the revenue that we eventually recognize. So yeah.
The next question here is on our growth priorities and spending funds from the IPO proceeds over the next 3 to 5 years. I think in terms of growth, our primary areas that the company is focused on is really expanding our publisher network. That just gives us access to more consumers to be on the platform, redeeming offers, as we've kind of discussed. And then along with that, it's really expanding the budgets with our CPG partners, both current partners and expanding to, I think, new CPGs, so that there is more content available across all publishers, including our D2C app, to be redeemed. And that's really going to be a continued area of focus for the company, is just in terms of growing top line revenue. I think in terms of the use of funds, what that typically looks like is just investing internally in headcount, people who are working here, selling to CPGs, or going in and acquiring new publishers for the network. And then, another thing we've done most recently was announced a share repurchase program. And so we've used some of our cash on hand to go out and purchase shares in the market. And that's kind of an ongoing effort as well.
So expanding on MC's point about increasing CPG investment in our platform, the next question is about essentially securing incremental budgets from our CPG partners and how we grab a larger portion of the overall CPG marketing spend, and really what convinces CPG brands to shift from other mediums to Ibotta. And we've really been talking about this a lot recently internally. So the way that we think about that is Ibotta is a pay per sale model, which means that the CPG brand only pays us if a sale of their product occurred. You can imagine how this is an attractive medium to invest marketing dollars as compared to other mediums such as television or radio, for example, where you put an ad on TV, but then you have difficulty tracking, how that ad necessarily led to incremental sales, and really the benefits that you ultimately get from that advertisement. Whereas with Ibotta, we can definitively say you paid X and a product was sold. And so we're really focused on continuing to educate our CPG clients on our business model. We're also making improvements to our measurement and what we call incrementality capabilities. So CPG brands are very focused on not only moving units, but moving incremental units that would not have occurred otherwise. And so really the way that we do this is we use all the data that we have on our platform to form a test and control group, and using scientific method and a lot of other complicated technology and statistical math that I am not fully up to speed on, we can say to a CPG brand, you moved X units, Y were incremental, which means that you paid a cost of, let's just say 30 cents for every incremental unit move. And as long as that cost is contribution margin positive, we believe that it makes a lot of sense for CPG brands to invest a lot more with Ibotta and really have what we would consider to be always on marketing. If something's going to improve both your top and bottom line, why wouldn't you invest in that, right? So that's really kind of where we're headed, developing those capabilities so that way we can convince these brands to shift budgets away from what we consider to be less efficient mediums.
The next question is around the kind of the competitive landscape and moat, and asking whether or not there's a risk that other companies, including either existing competitors or other large firms, might enter the market to emulate Ibotta's model. And what makes this hard, and how does Ibotta have a moat? So I think I've heard Brian talk about this a lot, and I definitely think it's true, and we've seen it play out absolutely with some of our other competitors. Ibotta, when it was originally started in 2012, was only a direct-to-consumer app. And so as we went out and started developing or sourcing budgets from different CPG brands, we were doing so in order to distribute that to users of our app, and they were shopping at all different grocers to redeem those coupons, which meant that we were sourcing big national budgets. And I think this D2C aspect really helped create the initial moat for the company, because it invites CPG brands to work with us because we have national resources and are able to distribute their content at any sort of grocer where shoppers can redeem their products or purchase their products. Because otherwise retailers and CPG brands would be limited to shopper budgets, which are specific to one given retailer and much smaller than national budgets. So I think that that in and of itself, the D2C aspect, and the fact that we really honed that and developed that for 8 years before we got into distributing, maybe a little bit less than 8 years, but distributing our content to third-party publishers in a white label sense. And so it's really what's created like this moat for us in the competitive landscape of coupon or promotions.
The next question is on ad agencies and marketing firms, such as those that are listed as partners of Walmart Connect. I would just note that we don't really have relationships that translate into meaningful revenue for us with ad agencies and marketing firms specifically. We primarily work with CPG brands, as we referenced before. And then the next question is, what do we see as a key driver of new user adoption and increased activity? And we really see the growth drivers of these two areas being one, adding new publishers to our network, as MC has mentioned. So that includes both grocery retail publishers, such as the partnership that we have with Walmart, but also other publishers outside of the grocery space. So that could include pet, beauty, electronics. And yeah, really, we think that that's another opportunity where we can expand into new verticals. Also, just in terms of increasing activity across our network, that's largely going to be driven by improved offer content. So you can think the better the offer, the longer that it is live on our network, the more likely you are to redeem that offer. And I would say also a factor, but potentially to a slightly lesser extent, would be the user experience, right? If it's a seamless user experience, you're more likely to come across an offer, see the offer, decide to buy that product, and ultimately redeem the offer. So I would say new publishers and better and deeper offer content and user experience are key areas of improvement that will drive growth in the future.
The next question is, what's preventing retailers from developing this capability in-house? And this is a great question. It's one that we get a lot. So I'll try to echo what Brian has mentioned before. But the crux of it is, I mentioned in one of my previous answers, the difference in national and then shopper or retail specific budgets. So it just to make sure everyone knows what that is. National budgets would be like a CPG brand has promotions that can be allocated across all different grocers. And so it could be Walmart, it could be Target, it could be Kroger, whatever. Whereas a retailer specific budget is going to be a set number of dollars that they allocate for their products specific to one retailer. So Target, let's just say they have $200 million where they want to promote their goods to be purchased at Target. And it could be related to initiatives around like driving use of a product in like an area where people aren't really purchasing it or whatever it might be. So the reason why retailers wouldn't want to develop this in-house is because if they do, they are limited to those shopper-only budgets. Where if they work with Ibotta and we are able to access those national budgets as well, they have more content to be like redeemed at their store past just what the shopper budget would be limited to, which means there's just more promotions available for shoppers and shoppers are getting better prices on the goods that they're purchasing. So it's really attractive for retailers to have that consumer experience available and that available not only through the shopper budgets, but through the national budgets because it's just more robust. And I would say there's also the aspect of with us owning these relationships and being able to provide more content, we also are able to provide, as James kind of mentioned, a better user experience. We provide the pipes for getting that content to them. And it's on something that for them is not like a very high margin business, but for us to do it and really like owning that relationship and those resources is profitable for us. So that's one of the reasons that we do, that we've kind of created what is now rewards as a service, that we do not only to each retailer, but then obviously on our third-party publishers and the D2C app as well.
The next one has a few questions in it, so I'll just take them one at a time. So the first one is about ensuring engagement with brands and consumers. I think this is a great question. And interestingly, the engagement with both of these different counterparts really mutually reinforce each other, that is. So first and foremost, you need to have a large scaled user base that then attracts advertising dollars, in our case, from CPG companies. And once you have that large scaled user base that attracts more ad dollars, which then puts more offers into the system and distributed across the network, which then attracts more redeemers. And you can see how that can create a flywheel. So really, we're focused on signing new publishers to scale our user base and increasing budgets from CPG clients, and then really letting that flywheel do the work. And then the next question is about exclusive partnerships with our publishers. And does that create a moat or barrier of competition for our competitors? Put simply, the answer is yes. Most of the publisher agreements that we enter into are multi-year strategic partnerships. So contractually, that provides a barrier and gives us an advantage over our competitors as we win those businesses one at a time.
The next question here, I'm not gonna spend too much time on it because I feel like it was kind of answered in a previous question. It's whether or not Ibotta is at risk of Walmart sourcing its own promotions, and how we're keeping it beneficial for both parties. But that's similar to kind of what I mentioned earlier with the retailer specific budgets. Walmart's desire to work with Ibotta is primarily because we can source national budgets that they wouldn't otherwise be able to source on their own. And this is true for every retailer. And then it's also just like more beneficial for them, for us to own the reward sourcing and the piping and everything else that I mentioned kind of earlier. So going on to the next question, it was whether or not our revenue is evenly distributed among partners or if there are a few key contributors who have large impact. And I imagine, you know, I think I kind of interpreted this question two different ways. I didn't know if you meant like third-party publisher partners or CPG brand partners whose content is available through the app or, you know, through to be redeemed. But I think the best proxy for this, no matter what you're talking about, is really going to be, if you look at like the grocery market, for example, and market share, that's going to be the best proxy for how our revenue is also distributed. So Walmart has a huge share of the grocery market in the US. And so that's a good proxy for how our revenue is distributed as well. And honestly, same goes for CPG brands that are like high frequently purchased products or have really large market share in whatever area it is that they are competing, are similarly going to see a lot of movement through our app and a lot of purchases or redemptions. And then the next question here is, are you predicting lots of new third-party partnerships soon, or will we start to see the decline in new partnerships in the next year or two? As we've mentioned, I think on a lot of different earnings calls, we do have a really robust pipeline. It's not only limited to grocery retailers. And so I think you'll continue to see that. I can't really speak to like when those would come online, but I think, you know, we've definitely talked about that we don't really see that stopping anytime soon. And it's not like we'll tap out the grocery market and then have no other places to turn. So as we've kind of mentioned, whether it be pet or e-commerce or what have you, there are a lot of different avenues that we can continue to add publishers to the network.
One more question on partnerships. So the question is, how do we choose which companies to onboard next? And are there any challenges that we foresee in growing our partners? I'll tackle the first part of that question first. So in terms of choosing which companies to onboard next, as MC mentioned, we have a pipeline. We really consider first and foremost what we believe to be size of prize right? So based on our internal estimates, how much revenue do we think this partnership is worth? What are the associated costs? And how will this honestly flow all the way down to cash flow? And really how we think about that is one, what does the company's scale look like? Is it a Walmart or a regional grocer? Would be one example of a framework to think about that. We also think about the overlap of our offer content with the products and UPCs that a retailer or online retailer carries. So right now we have the vast majority of our business is consumer packaged goods products. And so we'll look for strong overlap with primarily grocers because they are the retailers that for the most part carry CPG products. That's not to say that we aren't looking to expand into new areas, but really when we're thinking about size and price, that's what we're looking at. We also look at the digital engagement of a retailer's customer base, right? If a retailer has a very engaged customer base, and they also have a strong online presence with a lot of the technological infrastructure already built out for consumers to be able to shop online or be on their phone when they're inside the store. As we're a digital promotions company, that really lends itself to more redemptions taking place and therefore ultimately the size and prize being larger for Ibotta. So that's really what we think about. And in terms of challenges, I don't really foresee any notable challenges right now. As MC mentioned, and we've mentioned publicly, the pipeline is robust. So just focused on continuing to add more publishers and more offer content to help that flywheel accelerate.
Another question is around the regulatory landscape, and with evolving digital advertising and increasing regulatory scrutiny, how is Ibotta preparing to navigate potential changes in privacy laws or antitrust regulations? And are there strategic measures in place to adapt to such challenges? So the main thing I would say here is it's something that we are very aware of and ensure compliance around. So any changes that occur, we are always quick to adapt to. Within the D2C platform specifically, you do have to opt in, as you can imagine, to sharing any data. And so, while we do have that available, it's all compliant. And then I think with each publisher as well, there's very specific agreements in place in terms of what data is allowed to be shared to make sure that we're compliant at all times. The next question is around trade tariffs and anticipated, are any of them anticipated to affect Ibotta in the long term, I guess would be how that should read. And does Ibotta see the need to prepare for these tariffs? I think this will affect the companies that distribute content through Ibotta's app and therefore affect us as well. I think, I would rather not speculate at this point in time. We'll just kind of have to see what remains to be seen. It remains to be seen. Sorry, it remains to be seen. But one thing I would say is typically in an inflationary environment, this is a tailwind for Ibotta. And I'll just explain the dynamic of that really quick. So as inflation begins to affect our consumers when they are in the grocery store shopping for, their weekly groceries, as prices increase, they'll typically trade down to private label products. And what we see brands typically do is have promotions against their own products to allow these price-sensitive consumers, their products to better compete for these price-sensitive consumers. And so in an inflationary environment where this is occurring, there are typically more promotions through Ibotta to help promote these goods and decrease the price to convert consumers to purchasing their good in lieu of the private label good. Who knows how that will play out in the new regulatory landscape, but just wanted to kind of shed some light on what we've seen historically.
We've got two revenue questions. The first one is about our revenue streams, and then the mix between online shopping versus what we call in-store or in-person shopping. So in terms of our revenue streams, we disclosed these publicly. So right now, redemption revenue in the third quarter accounted for approximately 85% of our total revenue, while add another accounted for 15%. In terms of in-store versus online, on our direct consumer platform, a good, I would say, majority of the redemptions take place in store. Conversely, on our third-party publisher platforms, the vast majority of redemptions take place online today. And so we view this as a potential growth opportunity. The vast majority of grocery transactions still take place in store. I forget the statistic, but it's, I want to say north of 85%. So given that right now we're not fully capturing that opportunity, we feel that that's a growth lever and a potential tailwind for us. And so given that, the question also asks how we expect this to change over the next 3 to 5 years. I think to a certain degree, you could expect it to shift to in-store just as we further penetrate that area of purchases. But at the same time, as we all know, the world is becoming more and more digital every day. More and more people are shopping for groceries and other items online. And so I could see that almost partially, if not fully, offsetting the aforementioned in-store tailwind. So tough to say on the 3 to 5 year horizon.
Similarly, this one talks about revenue over the next 2 to 5 years. And whether or not we would expect increases in revenue to come from customers or redemption revenue or increasing prices. I think if you look historically, our revenue per redemption fluctuates, but not materially. So I would not make any large assumptions there. Where I think you're going to see growth really in Ibotta over the next years is going to be as we add new publishers, which is something that we've obviously talked a lot about on this call. It's been talked a lot about by management. That's the flywheel that James was referring to. And the more publishers you add, the more consumers you have access to redeem products. And the more consumers you have access to, the more CPG brands want to invest in your platform to promote with these consumers. And so that's really going to be where I think you see the most growth for Ibotta in the future. And obviously, I think the biggest piece of that is adding those new publishers and then growing those CPG brands. Let's see. The next question was on our acquisition strategy for internal growth, add-on services, small, big acquisitions, etc. Anything here would really just be speculation. There's nothing that we've discussed publicly, so I don't think really worth spending much more time on that. Strategy, do you want to take the next one on the competitive advantage?
Yeah, so it talks about our competitive advantage having a well-recognized direct-to-consumer platform and how moving to a white label third-party solution, whether or not we lose that advantage. We certainly do have a strong competitive advantage with our direct-to-consumer platform. Over 50 million people have downloaded our direct-to-consumer app. And that, to our previous points, allowed us to secure a vast amount of national offer content, which we can then distribute across the network. In terms of whether or not this is quote unquote a lost advantage as we move to the third-party publisher white label solution, I don't think we necessarily see it that way. We're more focused on engaging with these retailers and publishers to allow us to put our content on their network. And the consumer, since it's a white label solution, never really sees that it's Ibotta. So we don't necessarily need that recognition. It's more about having that relationship with the retailer. We call it a top-to-top relationship, right? A relationship with high-level employees, oftentimes executives at these retailers, to convince them to allow us to put offers on their platforms and the associated benefits with that, right? So yeah, I think that's all there is to say there. The next question is about a comment that was made at our UBS conference. I touched on this a little bit earlier as well, but the question is asking, since we mentioned that CPG brands recognize benefits from our measurement, we call it, we use the term incremental cost per unit sold, and how we'll kind of hope to transition to an always on format of marketing for these CPG companies. Essentially, what we've heard from the question is what we've heard from CPG brands, how receptive are they to this approach, our measurement, our methodology, and when we can expect an inflection point. Really, this is something that we're working on building out as we speak. So in order to really employ our strategy and our measurement methodology, what we need to have is what we call targeted offers. So you can think of it as, James gets $1 to get him to shift from Kraft mac and cheese to Annie's mac and cheese, but MC already uses or already eats Annie's mac and cheese, and so we want to not necessarily convert her from a different brand, but we want to incentivize her to purchase more of Annie's, but we think that she only needs 50 cents. So it's about putting the right offer in front of the right consumer at the right time to allow for the most efficient use of spend for CPG clients. And so really where we are in the process of deploying our updated and new measurement methodologies and targeting is that we've always done somewhat rudimentary form of targeting. We call it manual targeting, where we will essentially bucket redeemers into one of 4 categories to allow that offer to be slightly customized. But what I was just referencing is a much more advanced form of targeting that is using AI and machine learning to drive that offer recommendation. And so we're working on building out a dashboard where clients can monitor performance really at any time by the end of the year. Then we're rolling out that manual targeting really beginning of next year. And I believe Brian has commented on this across the network. And then we'll move more towards the true machine learning AI targeting towards the back half of next year. And we've really received positive feedback from clients on how they would expect to use this product and how it might translate into larger budgets and therefore more revenue for us.
Thank you. It is 1 o'clock, and I wanted to give you a quick break, possibly, if you're interested. The next question is on vision, and might be useful to jump in right after a 2-minute break if you like to stretch your legs, because I'm going to ask a question of all of the students now. Just go ahead in your chat. Let me know how many questions you want to ask. So just say 1, 2, whatever. Go ahead and type that into the chat now, and that'll give us a chance to see where we are in terms of our time. Mary Catherine and James, if we do have something like 20 minutes more of talk time, would you like to go ahead and take a 2-minute break right now? Because I have a feeling we're probably going to be another 20 or 30 minutes, just my ballpark.
Yeah, sounds good.
Okay, awesome. Well, let's take 2 minutes then. But we'll come back. We'll start when you start again. So we'll be back in a minute. In the meantime, go ahead and let me know how many additional questions everybody has. Okay.
All right, we can go ahead and hop back in, Peter, as you suggested, with the Ibotta's vision for the next 5 years. So definitely something that I've heard Brian talk about, and this is kind of as James mentioned earlier with the, I think it continues to be a focus on delivering the right offer to the right consumer at the right time. And his vision for this, and as James mentioned in the very first question, is not only as it relates to dynamic shelf tags. So you would be walking down an aisle and the shelf tag would have a promotion included on it that would be serving you an offer based on, you know, who you are, et cetera. But I think it's also something that one of our most recently announced partnerships, Schnucks, is testing these grocery carts that we also could see like an integration to in the very long term, right? And these are just like specific examples in terms of the 5-year vision. But it would be, as you're walking along a grocery aisle, right, you would be served offers based on what is available to you in that store. And the offer would be dynamic, would actually understand which aisle you are in, the products that are around you, and then who you are as, like, based on if you've already entered your phone number or some sort of customer ID, it would know who you are, and as James mentioned earlier, whether or not you're more likely to buy Kraft mac and cheese versus Annie's or Pepsi versus Coke, and serve you offers accordingly. Now, that might not be like a 5-year vision, that might be more like long-term, but I think that really speaks to how Brian views the company and our long-term objective of, again, rewards as a service, so it's not just distributed through the app, it's distributed through all of our partners as well. And it's it's making every purchase rewarding and delivering the right offer to the right consumer at the right time. So totally based on your shopping experience. And then I think really like that, it all goes back to some of the other flywheel effect things that we've talked about. It's adding those publishers, it's reaching more consumers and reaching more CPG brands, making it easier for them to get into the broader Ibotta platform, load their different budgets, have those distributed where they want them syndicated to, the retailers they want them syndicated to, the users they want them syndicated to, targeted in the right manner. It's just making all of that experience a lot easier for all of our different customers, not only the shoppers that we obviously view as our customers, but also the brands and the retailers as well.
The next question is on AI and technology investment. I feel like we covered that pretty well in the last 2 questions. It does ask whether or not, these advancements that we're making are our competitors leveraging them? The short answer is no. Really, obviously, AI and machine learning is quite the craze right now, but no one within our specific promotions niche is offering, what we are. The ability to place the right offer, we'll say it again and again, in front of the right consumer at the right time. This is something that CPG brands, based on our discussions with them, find deeply valuable, and we are the only ones doing it, the only ones with the data set to do it. And so from that perspective, we feel like it gives us a very long and significant runway for growth. So that's it, I think, on the AI and kind of measurement and offer targeting. I'll just knock out these last 2. They're about user acquisition and retention metrics. How do we balance acquiring new users and retaining existing ones? This is really only a factor for us on our D2C platform. For the most part, we let our publisher partners handle the acquisition, retention, and overall marketing strategies for their rewards program. We obviously opine on their program. We give them suggestions and advice, but ultimately that is theirs to own. So as far as the D2C platform goes, this is a business that we've had for 12 years now. So the retention and acquisition metrics are all very stable. Our marketing team is highly dialed on how to manage those metrics. I think this is evidenced if you look at our sales and marketing spend that's publicly available through the SEC.gov website and our SEC filings. You'll notice that we've done a very good job at becoming more efficient with our sales and marketing spend. And then as far as retention on the acquisition and user metrics on the third-party publishers, outside of what I noted previously, I would also comment that really what we've noticed is the most important factor is the quality and quantity of our offers on that publisher, right? So that's truly what's in our control. And so that's why we're so focused on expanding budgets at existing CPG clients, with existing CPG clients, penetrating other clients and brands that we don't currently work with, and then also expanding beyond grocery to general merchandise. I mentioned previously, pet, health, beauty, home care, the list goes on and on. Yeah, that's all the questions.
Those were the questions in the list. Peter, do you want us to knock out the ones that you sent across via email quickly before?
Yeah, let's go ahead and knock those questions off. I think some of them have already been answered, but you
Yeah.
can address probably a couple of them that haven't been touched yet.
Yeah, I can just kind of speak to, um, let's see here. The first being, so sales trends. For sales trends, I would just say to look at consensus estimates, honestly. The other is, the next is best use of cash, but we kind of talked about the investments in the business really being, the people who are working here and growing the, I guess, the number of people here to go out and get budgets, et cetera, get new publishers. Emerging competitors and what sets Ibotta apart. James spoke to this and kind of citing, Fetch, there's Neptune, et cetera. But I think we've kind of spoken to the mode that we created there. And obviously, having been in the business since 2012, really had time to develop those partnerships with our retailers, with the CPG companies. And as James also mentioned, there being multi-year agreements in place with some of these companies in and of itself develops a bit of a moat. Biggest issue for growth in our business, would it be receivables, traffic? So the way I read that is really like traffic, meaning like traffic on the website. And I think as we add more publishers, this kind of speaks to the flywheel effect. I think that becomes less, or it's not too much of an issue because they have all of their own consumers that they're marketing the platform to. And so adding new publishers helps us to have a very healthy amount of consumers on the broader platform and on the network redeeming offers. I would say possibly what was spoken about this year, in Brian in our third quarter earnings call, was that we in some ways like depleted our budgets a lot more quickly than expected. And that became, at least as he spoke to kind of coming into the fourth quarter, the biggest restriction on our top line growth. But it's not something that we, I guess, would say is going to be a long-term issue for growth, because as these budgets reset, you're able to go in and just increase that for next year. It was just kind of like we outpaced the growth of the consumers on the platform, outpaced that budget growth in the fourth quarter. The last one, how do you interpret that, James? What are your catalysts? What motivates them?
Yeah, I assume that's asking what are the catalysts for the business. I think we've touched on those pretty well.
All right, thank you. Now, we did have a few teams that probably had some other questions they wanted to ask that were not directly in this list. They can ask them now as we open up the floor to any students who want to ask a follow-up question. So we're not going to have any particular order of this. Just feel free to jump in and ask your questions when you're ready.
Hello. So in your prospectus and your 2022-2023 accounts, it's clear, given the short-term nature of the deals, that working capital is working capital sort of dominates the balance sheet. Given that's the case, could you give an overview of your working capital management strategy? And then specifically within that, accounts receivable has seen a pretty heavy growth. What issues has Ibotta run into in potentially collecting on accounts receivable? And what standards are there in internal controls around recognizing and writing off uncollectible accounts?
Great question. So we spent a lot of time thinking about our cash flow and working capital, specifically accounts receivable. We've spent a lot of time on our accounts receivable. And I think that what you might observe is that so with our accounts receivable, as we collect on that, is typically, so we're collecting both the redemption fee and we are collecting the Saver Award from those CPG brands. that we then need to recognize as revenue and or pay out to the consumer. So when you're thinking about that, it's not really just our revenue that we're collecting, it's that saver award as well. But we manage that well within kind of the payment terms that have been agreed to and are able to pay those out before the consumer would cash out. Typically, I should say, generally speaking, before a consumer would then cash out their account via Ibotta. And or within the terms that we would then need to distribute the reward to a third-party publisher. But one of the dynamics that you may be observing is that as you ramp your revenue with a new publisher, you're ramping that revenue more quickly than you're collecting that cash, which is oftentimes the dynamic you see play out in our working capital and the pull on our working capital as that revenue is scaling drastically. But it's not something that I think is an area of concern, at least not at this point in time. And it's something that we spend a lot of time and resources to manage because there are obviously a lot of brands that we work with. And we have to manage those relationships very closely to make sure we are collecting on that cash before we do need to pay out to whether it be a publisher or a consumer. Anything else you would want to say on that?
That was great. I would just add the end of the question. You mentioned, do we have standards to recognize bad debt, uncollectible accounts? Yeah, we certainly do. There's a very rigorous process to ensure that anything that we deem uncollectible becomes bad debt.
All right, lovely. Thank you.
Next question.
Hey guys, this is Zach from Colorado State. I have a quick question about AI and machine learning. You mentioned an internal data set. I'm curious what sort of data you guys are collecting and also like what sort of opportunities there are to share data with, some partners like Walmart, Instacart, and what the implementation, of this, getting the right offer in front of the right person at the right time, what that looks like for you guys. In terms of cost at the end of next year, like you said.
Yeah. So in terms of the data collecting in the rich data set that I mentioned earlier, so that's going to come primarily from our direct consumer platform, but also from our third-party publishers. So I'll start with D2C. So on the direct consumer side, consumers oftentimes will link their loyalty accounts between Ibotta and the retailer. So if I shop at King Soopers here in Colorado, I can link my King Soopers account to Ibotta such that I do not have to upload a receipt to get cash back. Ibotta will get that transaction feed and then automatically recognize that a redemption takes place, and then my account will be credited. And so the advantage of having this linked loyalty account is that it's more or less a continuous feed of data from the retailers. So that way we can verify whether or not an offer has been redeemed. So you can imagine that, just using numbers that are publicly available, we have 2 million approximately direct consumer redeemers on a quarterly basis. That's a lot of transactions if, James as a redeemer is shopping 4 times a month. So we can use that rich data set to our advantage to then use machine learning and scientific method and test and control to say, okay, CPG brand, these sales that took place were incremental. They had a cost of this, which ultimately, they know is contribution margin positive for them. So that's kind of the vision. On the 3PP side, third-party publisher side, we also get data to verify whether or not a redemption has taken place. Since the data is occurring on a third-party platform, we don't get quite as much information. It's anonymized. And so it's not quite as rich as D2C, but still valuable data, right? The opportunities, yeah, this will allow us to scale our budgets with CPG brands. We've spoken to many of them, and they think it'll be valuable. They actually share the data with us, our publishers, not vice versa. And then in terms of the cost, there's some headcount associated with building all of this functionality out. Although we do have a lot of very talented software engineers, machine learning PhDs already at Ibotta, and the technology is very scalable, right? So there's, for every incremental dollar of revenue, there's not much cost. And so from that perspective, we think we're in a pretty good spot to execute on this measurement and machine learning strategy to really kind of inflect our business over the next 12 to, I don't know, 18.
Thanks for the clarification.
Hi, I'm Carly from the University of Denver. I have a question. So given that you mentioned you have like a lot of cash on hand and you're not thinking about taking on, as much additional debt next year, to clarify, is there like any interest in using M&A activity to grow Ibotta?
I'm sure if the right opportunity presented itself, that there would be interest. It's just not something that I think we have commented on publicly, so I hesitate to speak to it too much. Historically, we have not been extremely acquisitive, but it doesn't mean that we wouldn't be in the future.
Great, thank you.
Hi there. My name is Fletcher Lippert from CU Denver. I just wanted to talk to you guys about your second quarter. We saw a loss, or a decline rather, of direct-to-consumer redemptions on a year-over-year basis. And
Oh, the
I was
moose.
just wondering if there was some
Oh no, our
context to
friend
that.
has just never seen a moose in Colorado, and she's lived here for 40 years, and we see them all the
somebody's
time.
on-
So every
somebody's
time we
speaking.
find a
Go ahead and
moose,
mute.
it becomes a gift.
I'll figure it out.
She doesn't, yeah, this way she does. Yeah. It's pretty funny. She's kind of over it, but we think it's funny still.
Print receipt, email, both.
Email's fine. Thank you. Thank you.
I'll figure out my controls. Anyway, go ahead and speak. Thank you.
I think you're asking a question, Fletcher.
Yeah, sorry. I didn't know if somebody was speaking, but I was just wondering if you guys could give a little context to the second quarter, why there was a decline in direct-to-consumer redemptions over the year.
Yeah, so that's really going to be a function of the dynamic that I mentioned earlier, where we're largely agnostic as to where a redemption takes place. So if you think about a network kind of as a funnel, right? So if CPG dollars get dropped in at the top of the funnel and then they get distributed across the network, if one node of the network, in this case, our third-party publishers, is larger than the direct-to-consumer business in prior years, such as 2023, right? The larger node is going to soak up more of that volume and budget, leaving less for, in this case, the direct-to-consumer node. So that's really the dynamic that's going on there. And so what we've done is encourage the street to look more at total redemption revenue as compared to, or as opposed to the split between direct to consumer and third party publishers, just because we get paid regardless. And total redemption revenue in the second quarter, I don't have the numbers on hand, but I know it was very meaningful double-digit growth, if not triple-digit growth. Does that answer your question?
I guess I can just follow up with, would you really see this sort of trending over time? You know, your company's getting bigger, but at the same time, grow or decrease over time? I'm just kind of wondering.
I think you may have cut out slightly there. But I think you're just asking if we'll continue to see a decrease to see more redemptions.
Yeah, sorry. Is this going to trend over time? Will we see like a steady decline, but the company, naturally growing still?
Yeah, I do think, as we've communicated to the street, we expect to see top line growth. And then when you look at each of the verticals specifically, D2C versus 3PP, as James said, we're kind of agnostic to how the overall platform grows, as those buckets from CPG brands are moving and consumers are receiving awards. So yeah, I think if you look at historical trends, you could make some assumptions there, but the overall top line of the company we continue to expect will be strong.
Perfect. That answers my question. Thank you.